So who controls the family bank and how is that control documented? What are some of the legal implications and possibly some downsides of providing free money or interest-free loans to some of the beneficiaries? How would implementing a family bank into their estate planning structure, how would that provide benefit to them, and how can they move money from one LLC to another? All right, Rick, now we're going to transition a little bit, and we have received some questions on our YouTube channel and throughout our various channels on the internet. So I'm going to ask you a couple of those now. First, focusing on our family bank structure. So who controls the family bank and how is that control documented?
So thank you for the question. I really like that question, and I love the family bank. The point of the family bank is that it is controlled typically by mommy and daddy, the client, and the magic of how that happens is in the structure. So a family bank, as we noted in our video, it might be a trust, it might be an LLC, it might be a limited partnership, and each of those entities has a different mechanism for how it's controlled. More likely than not, it's going to be a combination. So it might be, for example, a dynasty trust that owns a non-controlling fractional share of an LLC or a limited partnership, and mommy and daddy, either through their trust or through a management company, owns the controlling interest. So we can divide up control versus equity, and we can keep control where we want. It's important to note that control is one of those fickle things. Just saying, this is kind of blunt, but when you're dead, you've lost control. And usually leading up to that, there's a period of time where our capacity may not be gone, but it's at least declining, it's diminishing. And so it's rational and appropriate and actually often crucial that at some point control is shared, and as capacity continues to diminish, the share shifts from the grantor, from the person who set it up, to the next generation, which is all the more reason why integrating the next generation and having them involved in the business and the family and the estate and financial structures early on, so that they have experience, so they're not just thrust into this role blind at an advanced age. They've been doing it for a long time. So control starts out, Daddy Warbucks and Mommy Trophy Bride keep control until they can't.
Yeah, and I think that goes back to what we were talking about previously, but just including the family, including the decision makers, the key players in your trust, especially those who are going to be involved when you are not here, involved in those conversations early on, so it's not just sprung on them at a stressful time in their life, I think is so important. So with what you just said about the family bank, talk about the differences between that and a self-directed IRA. We get a lot of questions about that.
Yeah, so first of all, self-directed IRAs can be awesome. They can be a very powerful tool. They can also be a quagmire that can be expensive and messed up, depending on how appropriately you employ it. An IRA is a statutory device for accumulating retirement funds. And depending on whether it's a Roth or a traditional, you might be putting in pre-tax dollars that get taxed later, or after-tax dollars and then they're tax-free. But that's created by the politicians. And I'm a little cynical here, just me thinking here, when the politicians create something and say, this is a good deal and you should do it, be cautious.
That's when the eyebrows go up. Yep.
Yeah, be cautious. Just watch out, buyer beware. There can be some really good things come from that, but you are governed by the politically created rules. And the people who make the rules can change the rules. So IRAs are subject to ERISA and other laws that govern what you can and cannot do and how you may or may not be taxed. The family bank structure that we're talking about is completely private. And when I say completely private, there may be trusts that are private, there may be business entities that are formed under state charter, but it's still privately organized, right, and it's privately owned. It's not subject to the IRA rules. So you have far more flexibility. And by the way, there are many ways to defer taxes other than a traditional IRA. And so particularly for the entrepreneur who's building a lot of wealth, an IRA may or may not be the right vehicle. For somebody whose estate is small and they have a withdrawal plan, they know how they're going to get out of the IRA before they get into it, then the IRA can be a really good deal, especially if you have an employer contributing to it. But it's very different than the privately structured family bank that we're talking about.
So going back to the family bank, let's say we have the hypothetical client, and there's probably a bunch out there. They have a revocable trust and they have a couple of LLCs. How would implementing a family bank into their estate planning structure, how would that provide benefit to them? And how can they move money from one LLC to another, or one LLC to the trust?
So that's a great question, by the way. Often the family bank is going to be a parent entity, and its ownership is going to be diversified, shall we say. The family trust, the revocable trust that the clients have, will probably own a piece. Often there's a management company that may or may not own a piece, depending on whether it's an LLC or a limited partnership. And a third potential owner is a dynasty trust,
Right.
an irrevocable dynasty trust. And there's different reasons to do or not to do that particular structure, depending on taxes and the size of the estate and the goal to manage risk. But in that structure, if you have a parent entity that owns a series of subsidiary LLCs that can own rental properties, or the lab, or the operating business entity of some kind or another, then that family bank entity can be a clearinghouse. So if you have money in entity A and you need money in entity F, instead of going between them, which creates due tos and due froms and is complicated for tax reporting,
It's very messy.
that money can flow under a partnership structure up to the family bank, and from the family bank back over to the other entity. So the family bank kind of becomes the clearinghouse through which money goes back and forth. And that flow of money can be structured in a variety of ways. It can be a distribution of income, it can be a loan, it can be a capital contribution or a capital withdrawal. So it does take some knowledgeable planning and some coordination with often whoever's doing the tax reporting for the client.
Yeah, definitely. Okay, Rick, I'm going to ask you this one exactly how it was worded, so bear with me here. How can a family bank develop liquid capital without legally interfering with the compounding of dividends?
Okay, this is kind of a bizarre question that in some ways shows that we have apparently not done a good job of explaining what the family bank is. First of all, everything in the family bank, it doesn't mystically come from somewhere else. You put it there.
Right.
The family created it. This is the family's wealth. It's the family's portfolio assets. It's the family's business entities. And if I understand how compounding works, and I think I do, you don't want to disrupt it. You like that.
Right.
You want compounding interest either works for you or against you. And the point of the family bank is you can structure it so that it works for you instead of against you. So I don't think you want to disrupt that. I think you want to exploit it.
So building off that, so what are the key communication strategies that you like to employ when you are speaking with a client for the first time about this structure? Do you recommend that they bring everyone with them that they want involved, either it's kids or advisors, or is it more of a, I want to get them on board first and then hopefully we can get everyone else later?
Well, yeah, there's a sequence. Usually the decision maker has to be on board first, because they're going to decide thumbs up or thumbs down, we're doing this or we're not. But once they decide, yeah, I want to do this, then really it's a team play. And you have to get the whole team involved. Whoever's doing the accounting, the bookkeeping, and the tax reporting has to be on board. And it's kind of interesting. We float this idea to some CPAs, and we get kind of two different reactions. One is, this is scary. I've never seen this before. I don't know how to do it, and it must be wrong because I've never heard of it before.
Right.
Then we get the others to go, oh, this is cool. You're going to like this so much. There's so many powerful things you can do, and I get it completely. And if that's the response from your CPA, then our level of confidence that you're going to get the best use of this structure goes way up. Because more often than not, you're going to call the person doing your taxes before you call the lawyer. People are afraid to call the lawyer. They don't want to pay legal fees, even though often we need to be involved in that conversation. So if you ask the person, well, how am I putting money in? How am I taking it out? And we can have that conversation. And typically with the family bank structure, the way we've set it up most of the time, you can put money in, you can take money out, and you can just do that on the fly. And then we're going to figure out, well, what's the most tax efficient way to characterize that? When you took money out, was that an income distribution? Was it a capital withdrawal? Was it a loan? And it can be any variety of those things. And often we have mechanisms set up in advance. For example, we often have a line of credit set up so that when they take money out of the family bank, they're drawing upon a home equity line of credit and drawing upon equity in their house to protect their house for other reasons. So the bottom line is, though, can I get the money out of my family bank? Well, yeah. And then we say, well, what do you want to get it out for? And they go, well, I'm going to buy a new rental property. Yeah, you're not taking the money out of the family bank. You're going to use the money in the family bank, which is a kind of another nuance that people have to come to terms with.
So sticking with the family bank, Rick, are family banks, are they legally permitted to pay dividends to the family investors?
Well, a family bank is a business entity. It has owners. Now, typically the owners are going to be a series of trusts, including a dynasty trust, but also outside family members can invest or be involved in that. So when we're doing multi-generational business deals, for example, there will be more than one entity. There's this one thing does it all approach isn't going to work. So there will probably be some kind of ancillary entity that's doing the joint business deal between mommy and daddy and one of their children or in generation 3 or whatever. And yeah, business entities can pay their owners dividends. So what that takes is knowledgeable legal and tax structuring to make that happen. So yeah, you can do that, just follow the rules.
So typically when I'm transacting with a different bank, the terms securities, promissory notes, different credit, that comes up. But how do those terms come into play when it's my money, when it's my own family bank?
Yeah, so this family bank, it's not a bank technically. We're using the bank descriptively for its function within a family. So it's not an investment fund that you're going out and promoting and getting third-party investors to put their money in and get a piece of the dividends. It's not. This is for family members and for related party transactions. So if you're going to loan your daughter or your son money from the family bank to buy a house, and you're going to structure that so that the loan is documented with a promissory note and it's secured with a mortgage or a deed of trust, that's a private party transaction. It doesn't have to be registered as a security. It's just a family deal. Now, there are rules on what kind of interest you have to charge, and it has to be commercially reasonable. But if we satisfy all those things, then it works, and there's no special registrations or filings required.
So with all that being said, do you think there's a minimum net worth or a minimum, yearly income to incorporate a structure like this?
So that's a great question. The more you have, the more it's worth it,
Sure.
obviously. But we've had situations, and I'll give you some numbers. We've had people come and they're concerned about professional liability or just business liability. Somebody that has a truck and hauls things that go boom and doesn't want to have their personal net worth exposed to that liability. And there are no claims, so we're not doing a fraudulent conveyance. Sometimes that family bank structure will set that up way in advance before there's a problem and fund it because the client says, well, I only have $800,000. I know that's not millions and millions, but it's the only $800,000 I have, and I want to protect it, and it's worth the overhead and the tax reporting and the due diligence and the compliance that you have to go through to make that work to protect that money. So it's really more of a question of cost benefit, and if you have extreme risks or extreme costs, a smaller amount of assets, it might be worth it. But for sure, when you get big, and big is a subjective number. When you get big, it's very worth it.
Yeah, I don't typically like to recommend a certain value in order to implement a certain plan. It's all about the risk tolerance of the client. Like you said, the $800,000 estate client, that's their only $800,000. They may want to protect that with everything that they can. We've also interacted with a lot of highly wealthy clients who just say, nah, it's fine, it's not going to happen to me.
Yeah.
And that's their prerogative. But it's all about your risk tolerance as the client and how much you want to protect the assets that you've worked hard to grow.
Right. And what's kind of funny is I've had this happen many, many times where the high roller says, oh, I've been doing this forever and I've never been sued and your fees are too high. I'm not going to pay for that. And then 2 years later, they're back in our office and go, I got sued.
Is it too late to
Is
do
it
that?
too
Yep,
late?
exactly,
And we
yep.
go, well, yeah, there are things that come off the table because you've already been sued now. There's still some things we can do, but it's going to cost more and not be as effective
Right.
as it would have been had you done something before there was trouble.
Yep. So within the family estate planning structure, what are some of the legal implications and possibly some downsides of providing free money or interest-free loans to some of the beneficiaries?
So, first of all, interest-free loans, for the most part, are a mythical beast that does not exist in reality. So even if you say, well, I'm not going to charge you interest, the IRS will impute interest. They'll impose interest. They'll treat you as if there was interest. And so there's actually minimum interest rates depending on the term of the loan that are published. And that can be mitigated a little bit by the market. We've seen times when the market had one interest rate commercially available and the federal rates were not aligned with that. In those situations, we can go with the market. So if the market is, for example, giving us low interest rates and the federal rates are high, yeah, we're going to go with the market rates because they're commercially defendable. But you have to have interest, and you want to have interest. And it's not just free money. It's not just that you get a loan and you never have to repay it and there's no consequences. No, that's not. Banks don't work that way.
Right.
You go to a bank and say, give me money. They're going to say, okay, we'll loan you money if you've got collateral. The loan should be collateralized. And in the trust we build, our Dynasty Trust, they're required to have collateral. You want the loan? Give us collateral. Give us a lien against your house. Give us a lien against your business. Give us a lien against your portfolio, something, so that the loan is collateralized so that you have an incentive and an obligation to repay it. And if you don't, there are bad consequences.
So how do you deal with some of those situations that may arise in that instance? Let's say a family member has taken a loan from the family bank and they've defaulted on the loan, or they're living in a trust-owned or a family bank-owned real property, and then they need to be evicted for whatever reason. They're missing payments. How do you handle that?
Wow. So that was a compound question. And so I'm going to give you two answers.
Break it up, yeah.
So yeah, sometimes, when the family member defaults on the loan, candidly, sometimes we do that on purpose. Sometimes a family member, for example, they have a loan to buy a house, and then there's some catastrophic event, and there's a judgment rendered against them. Sometimes the best thing they can do is default on the loan on purpose, and let the family bank foreclose. Because when the lender forecloses, it's going to scrape off that third-party liability, whatever it may be, depending on the circumstances. Sure. And that often, we see that happen candidly. The most common event is divorce. The deadbeat ex won't help make the house payments, and it's contested, and they're fighting about it, and nobody's making the house payments because the marriage is in distress. Who wants to make payments on the house where all the noise and drama is happening? So once again, the family bank can foreclose on the house and protect the offspring of the grantor, and the deadbeat ex is going to be kicked out the door. Yeah. Now, your other scenario of what happens if you have a family bank-owned asset that the beneficiary gets to live in. Right. And I actually had this question just yesterday, which is really interesting. So, wow, I'm letting family member live in this family house, but they have 11 dogs, and the dogs have destroyed everything. They've ripped up the furniture, they've peed on the drywall, they've done so many nasty things that they've really depleted the value of the house. Well, depending on how the trust or the instrument is written, we have recourse. The legal remedies don't go away just because the parties are related. Now, it's complicated because, we have to go tell this family member, yeah, either you get rid of the dogs or you have to move out, or it's just, we've given you so many warnings and you've now crossed the line, we're evicting you. And they can be evicted. So that you have to add the family drama of uncle's going to disinherit niece or whatever, or evict niece, which is one of the reasons why sometimes it's beneficial to have an independent trustee or an independent third party. Blame it on the lawyer. Let the lawyer wear the black hat and come in and say, I'm the new sheriff in town and you can't do that no more and we're kicking you out. Then the family member can hopefully maybe rescue the relationship a little bit. Yeah.
So with the family bank, and when you're structuring loans from that family bank, particularly against, let's say, a paid-off residence, how can you legally ensure a low or a no interest rate while also maintaining that legal integrity of the loan?
That's a great question. So it's important to understand what we've talked about in this structure is a home equity line of credit. So a line of credit is like a credit card. If you have a credit card and your borrowing capacity is $10,000, but you never use it, you never go out to eat, you never put gas in your car, you never buy a plane ticket or a hotel room on that, and the balance is zero, how much interest do you have to pay? Zero. But you have, in effect, used $10,000 worth of your credit capacity. So another lender thinking of loaning you money is going to look at that and say, well, we're going to factor in the possibility that you have the ability to borrow 10 grand on that credit card, and that's a factor in whether or not we'll loan you money or how much interest we'll charge you. So in the same way on this mortgage against the house, if you have $100,000 of equity and you put this $100,000 home equity line of credit, even if the balance that you owe is zero, you have obligated that house up to $100,000. So another creditor coming in behind you is in line behind that $100,000, whether or not you have used it. So as long as you don't draw on the line of credit, your interest is zero.
Yep.
Once you do draw on the line of credit, as we've discussed, there will be interest either imputed or by virtue of the contract.
Right, right. Now, lastly here, Rick, I want to switch gears to talk about life insurance and a little bit of estate taxation. So what are the legal rules concerning an individual's ability to get both the cash value and the face amount of the life insurance policy?
So life insurance is wonderful in one material respect. It's a private contract between private parties. Yeah, it's an institution. The insurance company is a big company, but then the insured is just, Joe client. It's me or you or one of our clients. And so insurance companies offer a variety of types of policies with various conditions. And so some of the answer of what are the legal rules is, some of the answer is, it depends on what your contract says, what your policy says. And some policies have more permissive lending rules, others don't. Some policies, especially these days, we see blended policies where there might be, for example, a disability rider or provision built into that, where for certain long-term care needs, you might be able to draw cash value out, and sometimes even a multiple of your contribution may be able to come out as a long-term benefit to provide for your care, and all of those kind of things deplete your ultimate death benefit. Now, to get the face value of a life insurance policy, I have good news and bad news. The good news is if you've structured it properly, you're going to get the entire face value and it's going to be tax-free. The bad news is you'll be dead. So I know that's
Quite the trade-off.
Yeah, it's a brutal trade-off. Wait, I buy insurance and the only way for me to win is to die. But you buy that to protect your loved ones and to fund tax liabilities and to fund buyouts of your family business with a partner and to replace income if the income earner's gone. So there's a lot of very valid and actually important reasons to use life insurance appropriately. But to get the face value, first of all, while you're alive, can I get the face value of the policy out? Well, you can only get out what's in there.
Right.
So you're going to get out what you've put in, and depending on how long it's been there and the particular variety of policy, hopefully that there's been some additions to what you put in through just the growth of the cash value inside the policy, and you can generally borrow that out, and the specific terms will depend on the policy.
So let's say I am the beneficiary of a life insurance policy. Are the proceeds that I get, am I going to pay a tax on that? Or what are the situations in which the proceeds will be taxed?
So bizarrely, and this is a gotcha, and this used to be more of an issue than it is today because the exemptions are so big. Even though you do not realize the cash benefit of the policy until you're dead, if you own a life insurance policy on yourself, the death benefit is included in and potentially taxed as part of your taxable estate for federal estate tax purposes. So, to hearken back a couple of decades here, when the exclusion was only $600,000 and you have a business owner go out and buy $1 million policy, well, just the policy all by itself is over the $600,000 exclusion. So that policy, inadvertently, the purchaser is paying premiums on that life insurance for the benefit of the IRS. So we want to structure that outside the estate, which is why we often put life insurance in an irrevocable dynasty trust. Now, if the estate is below the threshold, which currently is $15 million indexed to inflation, that may not be an issue. But another gotcha with life insurance, and I've seen this so many times, we have had to probate multiple life insurance policies. Because husband and wife, they name each other. One of the times this happened was, unfortunately, the married couple, both had big policies on each other, and they were traveling in a foreign country, and the traffic went in the opposite direction. They looked the wrong way when they stepped off the curb, and they both died at the same time. And two big life insurance policies paid two dead people. And their daughter, who, by the way, was a life insurance professional, was really furious. Why do we have to do probate? Well, you know the rules as well as we do. The policy can't pay to a dead person. We have to go do a probate on that. So, but there was no tax on that. It was just probated.
Right. Yeah. Well, Rick, it was a pleasure chatting with you. Until next time when we sit down and talk again. And we are attorneys at Durfee Law Group.
And we represent clients all over the U.S. and a number of foreign
Absolutely.
countries. So we love doing what we do. It's both fun and helpful. It makes people's lives better. So if we can help you, we would love to. If we can't, find somebody like us who can. And with that, we'll talk next time.
Thank you.